December 2025. Navigating the Chill of Uncertainty. A strategic guide to asset preservation and growth in 2026. The cold outside your window in December 2025 may not just be from the weather. The deeper chill comes from the extreme uncertainty and volatility in today's markets. At this critical fiscal year end, I'm not asking about your investment returns. Instead, I want to know, are you caught in a psychological tug of war? On one hand, you see certain asset classes experiencing irrational exuberance, fueling a fear of missing out, FOMO, on the last window for capital appreciation and upward mobility. On the other hand, you're gripped by fear of downside risk, terrified that a single misstep in asset allocation could lead to irreversible losses. This reaction is entirely rational. If you're feeling anxious, it means your risk perception system is working. Your instincts about the market are sharp. This psychological tension is a precursor to a structural market reset. Looking ahead to 2026, total macro wealth won't vanish. It's undergoing a massive and brutal reallocation of existing capital. Money, like a physical fluid, is flowing irreversibly from speculative, undisciplined, and highly leveraged players chasing short-term gains to rational, long-term investors with disciplined allocation strategies. This report is not about offering emotional comfort or baseless speculation. That's gambling, not investing. This memo is a strategic guide to asset preservation and allocation for 2026, designed for retail investors, the middle class, and individuals newly entering the high net worth bracket. Whether your investable assets, AUM, are as modest as $500 or as substantial as $5 million, establishing a survival and growth model aligned with your risk tolerance is urgent as 2026 approaches, because the fundamental logic and paradigm of the market have shifted. The past couple of fiscal years were a golden window for conservative investors. You didn't need to analyze complex financial statements or technical charts. Simply allocating funds to bank CDs or short-duration bond funds could yield 5% or more in risk-free returns. But that era of risk-free arbitrage ended in late 2025. With the Federal Reserve entering a rate-cutting cycle, this isn't just a US policy shift. It's a clear signal of declining global liquidity. Bank deposit rates may fall below 3%, even 2%, meaning risk-free returns will struggle to outpace real inflation (CPI). What does this mean macroeconomically? Holding cash in bank accounts will erode your purchasing power due to negative real interest rates. While inflation may be slowing, its cumulative effect is relentless. When risk-free returns fall below inflation, holding cash is a guaranteed loss in value. So where will capital flow? Capital is inherently profit-seeking and will chase higher marginal returns. It will inevitably spill out of low-yield bank systems into high-quality core assets that generate stable cash flow. This is the biggest structural opportunity in 2026, positioning yourself ahead of the crowd in the sectors where capital will ultimately land. But there's a liquidity trap. When risk-free rates are extremely low, the market floods with high-risk structured products, P2P variants, unregulated wealth management tools, or private equity deals promising 10% or 20% annual returns. Remember this ironclad risk rule. In a low-rate environment, any counterparty offering 10% risk-free returns is likely unsustainable and may be targeting your principal. In 2026, capital preservation is the top strategic goal. We're in asset allocation, not gambling. Before planning offensive moves, build your defense. For most individual investors, 30-40% of your portfolio should be in high margin of safety assets. This acts as a volatility damper. Even if the market crashes or a recession hits, a solid foundation prevents panic selling and actual losses. So what are the best defensive assets for 2026? Avoid speculative story stocks and focus on companies with strong rent collecting ability. Here, rent means consistent dividend payouts. Look for dividend aristocrats companies that have increased dividends for 10 or 20 consecutive years. This signals strong free cash flow and good corporate governance with a commitment to sharing growth with shareholders. Consumer staples, defensive champions across cycles. Regardless of economic conditions, demand for personal care, food and beverages, like toothpaste, coffee, or soda, is highly inelastic. This sticky demand provides defensive value. Consumer staples and food and beverage blue chips may have lower beta, less volatility than tech growth stocks, but they're resilient during downturns, your portfolio's safe haven. The hidden winners of the AI era, re-rating utilities. This may be the biggest market mispricing in 2026. Utilities and power companies. Historically seen as low growth, these sectors are now undergoing a fundamental shift. AI's explosive demand for computing power has outpaced power infrastructure expansion, a classic supply-demand mismatch. As tech giants compete for electricity, companies with grid assets and nuclear capacity gain scarcity pricing power. Power is no longer just a utility, it's the pick and shovel of the AI gold rush. Whether chip performance improves or not, without energy, it's useless. Utilities with stable grids and nuclear reserves are transitioning from defensive value stocks to essential growth stocks. With your defense in place, let's discuss offensive strategies. In recent years, NVIDIA's success epitomized the pick and shovel model selling tools to all miners in a gold rush, a highly predictable business. But by 2026, hardware infrastructure is nearing saturation. Shovels are everywhere. The next investment theme: who's using the shovel to create real value? Stop focusing solely on large language models. The model layer is now a capital war. Look for companies using AI to drive real profit growth. Is it the biotech firm that cut drug development time by 50% with AI? The logistics giant that reduced fuel costs by 30% through AI optimization? Or the financial institution that overhauled customer service with AI, boosting productivity? 2026 will be the year of AI application. Companies solving real problems and cutting costs, OpEx reduction, will dominate. Also, watch firms addressing AI-like energy solutions or advanced cooling tech. Reframing as digital gold. For offensive assets, crypto can't be ignored. But in 2026, reframe your view of Bitcoin. Asset classification. It's no longer a high volatility gambling chip. After multiple market cycles and ETF approvals, Bitcoin now functions as digital gold. Its core role is hedging fiat inflation and serving as a value store outside traditional finance. Recommendation: never go all in, avoid high leverage. Treat it as an alternative allocation. A small position adds anti-fragility. If it rises, it boosts returns. If it crashes, it won't harm your overall finances. Theory must meet practice. Here are 3 tactical allocation frameworks for different investor profiles. Stage 1: capital accumulation. Students, early career, under $50K, investable assets. Profile: new to the workforce with limited capital but a key advantage time. You have decades for compounding to work. Pain point: limited funds, chasing high alpha, vulnerable to misinformation. Core strategy: passive dollar cost averaging, bottlenecks, long-term holding, buy and hold. Avoid technical analysis or short-term trading. With small capital, transaction costs and time waste outweigh potential gains. Allocation: 70% in tech indices, for example, Nasdaq 100 ETF. You're young, with high risk tolerance, expose capital to tech frontiers, a proven beta play. 20% NS, P500 captures broad U.S. economic strength, stabilizing your core. 10% in high convex percent assets, Bitcoin, or a well-researched AI startup. Treat this as a lottery ticket. Losses are contained, but a win accelerates wealth building. Mindset: even a 20% market drop is a buying opportunity. For DCA investors, declines mean discounted assets. Accumulate shares you'll thank yourself at 40. Stage 2: wealth growth middle class. Family breadwinners, $50K, $1M, investable assets. Profile: the backbone of society, often with mortgages and family responsibilities. Pain point: lower risk tolerance. Major losses could devastate family life, but low returns won't fund education or retirement. Core strategy: core satellite approach, stable core, targeted growth. Allocation: 60% in total market index, for example. Diversified and safe your wealth anchor. 20% in sector ETFs. Pursue alpha in areas you understand. For example, semiconductors, healthcare. 15% in high dividend stocks or bonds. Generate cash flow for emergencies. 5 speculative. For individual stocks, options, or crypto. Losses won't impact essentials. Rebalance regularly. Don't chase others' short-term gains. Your goal is steady, snowball-like growth. Stage 3: wealth preservation business owners, pre-retirees over $1M, investable assets. Profile: wealth accumulated, possibly business owners or high net worth individuals nearing retirement. Goal: avoid drawdowns, tax efficiency. You don't need explosive growth, even 60% yields significant absolute returns. Core strategy: diversification, this anti-fragility. Allocation: core, low volatility, high dividend blue chips for passive income, tax-exempt bonds, municipal bonds, critical for tax-sensitive investors. Alternative investments, commercial real estate, or top-tier private equity requires expertise. Gold assets, ultimate insurance against extreme scenarios. 2026 will be a year of extreme market divergence. The era of buy anything and watch it rise is over. The future belongs to stock pickers, rational investors, and disciplined allocators. For inexperienced investors, here's a simple action plan. Log into your brokerage account. Set up an automatic monthly investment of $500 or $1,000 into S&P 500 or NASDAQ 100 ETFs. Then uninstall the trading app and forget the password. Just this step will outperform 90% of market participants. Ignore noise-driven news trading, it's distraction. Dismiss insider tips, they're traps. Only execution changes your balance sheet. Only time validates value investing. The future belongs to optimistic, disciplined investors. In historic wealth reallocation, may you be the one catching the wave, not the one left exposed when the tide recedes. Good luck. See you at the top in 2026.